The Dow Jones Industrial Average moves markets every single day. And for retail traders, it is one of the most accessible ways to get exposure to the US economy without buying a single stock. Here is how it works. A CFD, or contract for difference, lets you speculate on whether the Dow will rise or fall without owning the underlying index. You can go long if you think it will climb, or short if you expect it to drop. That flexibility is one reason index CFDs are popular with retail traders. But it comes with real risk, and we will get into that. First, understand what actually moves this index. The Dow tracks just 30 large-cap US companies. Because the list is so concentrated, a sharp move in one or two major stocks can shift the whole index. Compare that to the S&P 500, which spreads its weight across 500 companies. The Dow is more reactive. The biggest drivers are economic data releases, things like US non-farm payrolls, inflation figures, and GDP numbers. When that data beats expectations, the index often rallies. When it disappoints, it can sell off fast. Federal Reserve decisions matter just as much. Rate hikes tend to weigh on stocks over time. Rate cuts, or even signals of looser policy, tend to give equities a lift. Now, leverage. This is where traders get into trouble if they are not careful. When you trade the Dow as a CFD, you only put up a fraction of the total trade value. That deposit is called margin. If the margin requirement is 5%, $500 controls a $10,000 position. That amplifies your gains. It also amplifies your losses. A small move against you can wipe out your margin quickly. Trading involves real risk, and you should only ever use capital you can afford to lose. To manage that risk, you need a plan before you open a position. Define your entry, your stop loss, and your profit target. Many experienced traders risk no more than 1 to 2% of their capital on a single trade, and they look for setups where the potential reward is at least twice the potential loss. That ratio gives your account a mathematical edge over time, even if you do not win every trade. For chart analysis, support and resistance levels work well on the Dow, so do moving averages and the relative strength index. No single tool is reliable on its own. Use them together, and always let your risk management rules take priority over your instincts. Before you trade real money, practice on a demo account. Learn how the Dow reacts to news. Get comfortable with how leverage affects your positions. The time you spend practicing now directly reduces the cost of your learning curve later.